G'day everyone, and welcome to the second video in week 9 of our Legal Ethics and Trust Accounting course. This is the second week of looking at the basic principles of trust accounting. This week we're focusing on the different types of trust money. In our first video we talked about general trust funds and the nature of the general trust account. But I did say that there are other types of trust money. In this second video, I'm going to introduce you to another two types of trust money. These are called controlled money and transit money. Let's have a go, starting with controlled money. Controlled money is defined in Section 237 of the Legal Profession Act 2007, which says controlled money means money received or held by a law practice for which the practice has a written direction to deposit the money in an account other than a general trust account over which the practice has or will have exclusive control. Let's break that definition down a bit. First up, it's just money received or held by a law practice. So you might momentarily think this is different to trust money, which, if you remember from the first video, is money entrusted to a law practice in the course of or in connection with the provision of legal services by the practice. So that requirement for the connection to legal services doesn't initially seem to be there, does it? Well, a little further down in Section 237, in the definition of trust money, it says that trust money includes controlled money. So the definition of controlled money really needs to be read down with the definition of trust money. So if we combine the two, the definition of controlled money might be money entrusted to a law practice in the course of or in connection with the provision of legal services by the practice, for which the practice has a written direction to deposit the money in an account other than a general trust account over which the practice has or will have exclusive control. So we know what type of money we're talking about. We then need a written direction. If there's no written direction saying essentially deposit the money in an account other than a general trust account over which the practice has or will have exclusive control, then it's not controlled money. It's just general trust money. Let's say you do have a written direction. According to the definition, the direction is to deposit the money into an account other than the general trust account. So what you need to do is take that money, open an account in the firm's name with any approved deposit-taking institution, and only the firm can have capacity to operate that account. So you couldn't, for instance, have an account opened by the firm but with the client as a signatory. The name of the account must include the acronym CMA or CM account to show that the account is a controlled money account. So the big deal with controlled money is that it has to be kept separate. And so each firm has to have a separate system of receipts with even a separate numbering system for controlled money. So at this point, many of you will be thinking, okay, I get it. Controlled money is exactly like normal trust money, but it sits in its own account. Why would you bother? Well, it's true that there are virtually no practical differences between general trust money and controlled money. However, remember the basic principle: the money belongs to the client. It's the client's money. If the client doesn't want that money sitting in the general trust account, then you need some method to hold that money in a separate account, thus controlled money. To be honest though, this is pretty rarely the reason for controlled money. If the client doesn't trust you to keep your general trust account in order, they're probably not going to give you their money in the first place. The bigger advantage of controlled money is all about interest. Remember from video 1, the interest on money in the general trust account is all diverted into the Queensland Law Society's Fidelity Fund. And for most clients that's fine, they don't care. The amount of interest is likely to be pretty marginal. However, let's say it's not. Let's say, for instance, a client needs to put $10 million into trust for some reason and it's likely to be there for 2 years. Even at 1% interest, that's 200 grand. When money in a controlled money account earns interest, the interest doesn't go to the Fidelity Fund. The interest stays in the controlled money account. It gets receipted by the law firm, and ultimately it goes back to the client. That's probably the biggest advantage to a client of putting the money in a controlled money account. Having said that, they're still a pretty rare beast. I've personally never dealt with one. The rules contain really detailed processes for dealing with controlled money. We don't need to go through those in detail. It's enough for me to indicate that every movement of money into or out of the controlled money account has to be thoroughly documented, especially including client instructions to withdraw that money, no matter where the money goes after that. In addition, in any month where a firm holds controlled money accounts, the firm needs to generate a monthly report of all controlled money movements in all controlled money accounts for that month. I'm sure I don't need to underline the theme here. It's all about making sure that firms are absolutely accountable for their dealings with money that belongs to the clients. So, the key dot points for controlled money. It's kept in a separate account. Interest earned by that account stays in the account, and separate accounting rules exist to ensure that controlled money is dealt with in an absolutely scrupulous way. Let's push on. Next, I want to talk about transit money. Transit money is probably the simplest type of trust money that we talk about in the whole course. Transit money is defined in Section 237 of the Legal Profession Act as money received by a law practice, subject to instructions to pay or deliver it to a third party other than an associate of the practice. So in simple terms, it's money that's given to the firm so the firm can pay it on to someone else. When transit money is given to the law firm, the firm comes under a duty under Section 253 of the Legal Profession Act to provide the transit money to the third party, either within the time frame established by the client's instructions or else as soon as practicable. The Law Society's Guide to Trust Accounting gives the following kind of neat example of trust money in action. The law practice is acting for a client in the purchase of a property. The client delivers to the law practice 3 bank checks required to settle the purchase of the client's property and pay the relevant stamp duty and registration fees, with instructions as follows. Bank check payable to the seller, with instructions to hand over the check to the seller's solicitor at settlement. Bank check payable to the Office of State Revenue, with instructions to stamp the contract of sale and memorandum of transfer as agent for the Office of State Revenue and deliver the bank check to the Office of State Revenue. Bank check payable to the Department of Natural Resources and Water, with instructions to deliver the check to the department when lodging the memorandum of transfer for registration. Now, all 3 of those bank checks are transit money. But do you notice something about them? None of them required any money to actually go into the account of our firm. If the money is paid in cash, whether as actual notes or as an electronic transfer of cash, then it has to go into our general trust account first and needs to be accounted for as a deposit into the general trust account, and then we pay it to the third party in accordance with the client's instructions. Transit money, which is almost always in the form of a check, doesn't go into our accounts at all. We're just highly trusted delivery agents. So let's compare. 2 clients call you on the phone. The first one says, I have mailed you a check made out to the mediation service. Can you please forward that check to the mediator in payment of their fees? That's transit money. Never goes into our account. The second client says, I've just transferred you money to pay the mediator's fees. That money's in our account. If it's been paid into the business account, we need to immediately transfer it to the trust account and then follow the necessary trust account processes. So in short, transit money never goes into our accounts, not at all, not even for a few seconds. Any money that goes into the firm's accounts is trust money and not transit money. So, one more video to go this week. So far, we've learned about general trust money, which sits in the general trust account. We've learned about controlled money, which sits in a separate account all of its own. And we've learned about transit money, which never goes into our account at all. In the third and final video for this week, we're going to learn about 3 other types of trust money called power money, written direction money, and investment money. One more to go.